And because it's self-induced, it can be self-undone. And that's key for this risk. And I think that's what the market has figured out. The ability to undo the tariff risk. It's not like the housing crisis or the financial crisis where the banks were over leveraged, or the housing crisis was going to bring down the financial system. We can't just undo that with somebody saying, sorry, I'm going to kick something down the road 90 days.
Stock markets are hitting new all-time highs, fresh all-time highs. Let's take a look past the tariffs and economic uncertainty. Is there still underlying strength in both the economy and markets alike? We're talking about this with Chip Rewey. He's a CIO of Rewey Asset Management at RIA based in New Jersey. We'll be talking about his outlook. Thank you very much for coming back on the show, Chip. Good to see you again.
Hey, David. Good to see you. Thanks for having me back.
Yeah, you made some good calls last time about your outlook for not just markets, but sector-specific calls. Check out our last interview with Chip. Link down below. Let's start with the macro first. Data came in from the conference board today. The leading economic indicator, the LEI, dropped in June, 2.8% decline over the last 6 months. It signals a potential economic slowdown. It's usually a coincident indicator with some leading effects. Do you look at this and other signs potentially and make the evaluation that the economy is slowing down, or is that not your base case?
It's not my base case, but I do look at the data, and I think there's been kind of a consensus that the economy is going to slow all year, and it hasn't happened yet. So, not whistling past the graveyard, but I'm pretty much in line with what the Fed said at their last meeting. We'll probably see about 1.4. I know it's a dot plot, not an estimate, but the first quarter was negative. But if you look at net exports, it really took 4.8% off the number. And, so the second quarter normalized some of that back. And some of that negative 4.8 was gold imports, which was kind of crazy because those will never come back to GDP. Those will just get shoved in safes or whatever. So, the economy's kind of going along mediocre. CPI was a little hotter last time, a little under expectations, but a little hotter under month. PPI a little lower. You can pick data points, but I think the economy remains moderately healthy. Not too hot, not too cold. Maybe not just right, but I don't see us rolling off a cliff.
Well, despite the negative GDP print in Q1, many are still concerned about more negative prints throughout the year. Can you maybe walk us through your thesis for why recession fears are still overblown by this point?
Well, because they're in expectations. We've had a lot of worry. You can't turn on the TV even today. It's going to get worse. Almost every talking head comes on, it's going to get worse. We're bracing ourselves. Tariffs are going to lead to inflation. I think the banks have priced in this looming recession risk 2 or 3 times over. Smaller cap industrials have been kind of in a quasi down cycle, as has semi equipment, as had healthcare capital equipment. I mean, there's a lot of parts of the economy that are limping along. And yes, the AI story is strong, and I'm a believer in AI. I'm a huge believer in what that's going to transform society into. But I think there's been a lot of negative pricing in the market, a lot of uncertainty. And again, the weakness just isn't showing up. And if you keep trying to sell off, you might get this period like we're in now where people have to buy because the economy's just not that weak, and 1.4 on GDP would be pretty good for the market.
What are your expectations for Fed monetary policy and inflation for the second half of the year?
So I think rates in general and Fed policy gets a lot more attention than it should at this point. And I think it's caught up in the political theater that we see. And I think as any investor ought to try to divorce their emotions from investing and divorce their political views from investing. That said, I don't think we need a rate cut right now. The data doesn't argue for it. The economy's relatively healthy. If things slow, then maybe we can have a rate cut. But if GDP stays relatively positive, the economy can grow. So I don't think we're looming. I think people have priced one for the back half. I think if we get one, maybe due to the political pressure or something else, I think that'll be better for the economy. But remember, rates get cut on weakness. And again, so I think it's built into this, boy, we're going to have weakness and we're going to have a rate cut. Might be better for investors if we don't get any rate cuts and GDP stays strong.
It sounds like the perfect Goldilocks scenario for finance, for the economy, rather. We have moderately low inflation, rates are stable, the economy is stable in terms of growth, and the stock market is still ripping higher. So, is that the foreseeable future then?
Well, that's the future that we have. Who knows what foreseeable is, especially into August, right? Look, we're rolling
Yeah.
into earnings, and I want to dig into that a little bit and what I
Sure, let's
see.
do it.
But look, the economy is not weaker right now. The big banks came out and had great numbers. I mean, spectacular numbers across the board for some of them. And we really have the larger companies that report have been good. Now, the stocks have performed or not performed given expectations of what the number is and upside surprises. But it is kind of not too hot, not too cold into this 1-4 area. It isn't a consensus, but it's kind of what you have to build your models around now. And in that scenario where larger cap tech is kind of overvalued, I don't really think it'll crash down, but maybe go sideways and plateau. I think if we don't get any market scares and we get general relative consistency in the market, I'm not even using the word strength, but just consistency, it'll give investors confidence versus the uncertainty that we've had at the beginning of the year to look outside of the Mag 7, to look outside of the S&P 500 and try to rotate. And that'll be powerful. And if you look at, I think it's already happening. Look, the Mag 7, four of the names are down, right? Or four of the names are under the S&P's performance year to date. And a couple of them are negative. And I think we've had size as a factor in banks, in semiconductors, in most anything. If you look at the Russell indices, the larger caps have done better than the small caps. So size has been the prominent factor so far this year. And if we can get that stability without a falling off a cliff, I think it sets up well for smaller and Smid caps to run back, which we've seen the last 2 years, right? No, October, November, December have been great for small mid caps the last 2 years.
This is let's talk about that. This is the S&P versus the Russell. So, underperformance by the Russell over the large caps all throughout the year, all throughout last year. Even if you zoom in to the last 3 months when both have been rallying, it's performing the same. It kind of rewrites finance textbooks. I remember when I was in school, people were talking about how smaller and mid cap stocks have a higher beta to most large cap stocks, which in most cases is true. It's just not being observed now. Is there a reason why this is kind of just not being performing the way you would think it is? Is it counterintuitive to you as well?
No, well, it is counterintuitive, but I think the reason is it's expectations in this uncertainty. The larger caps have, as you said, they've got bigger balance sheets, right? I mean, that's just it. They can weather storms a little bit more. So when April 2nd, April 8th, April 9th rolls around, and all of a sudden the administration starts backing off of tariffs because they're unsustainable, which kind of was a view we talked about on your last podcast, the place to go is larger because you'll get the risk on. As that settles out 2 to 3 months later, the underperformers catch the eye of investors, in my view, and I think that's what we'll roll into. Now, that's the ETF kind of index point of view. I don't think ETF investing works down cap. I don't think there's a lot of liquidity in the ETFs. And I think if you use an active selection approach, you can avoid stocks with bad balance sheets and you can find things that aren't covered, right? There's over 5,000 names in what I consider my universe. Most of those aren't covered. Some of them don't trade well at all. You have to have a long-term time horizon on them. Some of them have one, two, three analysts. I mean, it's not like 40 analysts on the big banks or big semis or big AI companies. So if you do a little bit of work, I think it's easier to find. I think old school blocking and tackling analysis works better down cap.
Before we continue, let me tell you about protecting your most important asset, your personal information. Now, your personal information is likely out there on dozens of data broker sites you've never even heard of. These sites collect and sell your name, address, phone number, and more without your permission. That's why I use today's sponsor, Delete Me. It's a service that finds your personal data across the internet and gets it removed. And it doesn't just do it once, it does it continuously and monitors it and removes it throughout the year. All you have to do is submit your information, and within a week, you get a privacy report showing where your data was found and what's been removed. The whole process is simple, and it runs in the background so you don't have to think about it. Go to joindeleteme.com/DavidLin and use the promo code DavidLin at checkout, or scan the QR code here on screen to get 20% off on all US plans. Join Delete Me now and take control of your privacy today. A couple questions here. So the Russell being the way that it is has gotten some people saying things online like maybe you should just invest in the S&P 500. And I've seen this analysis somewhere, and I'd like you to evaluate it, Chip. The logic here is that the S&P 500 is constantly a rotation of the biggest large cap companies in America. To get to that position in the first place, this company has to be the best in the best in its class, the leader in its peer group. And so by default, you are investing in the best businesses based in America. And so by default, you will be outperforming if you're invested in this index. So just buy it, leave it, forget it. Don't worry about it. Can you evaluate that?
I don't buy into that premise. Yes, they're bigger companies, and the problem with the index is it's market cap weighted. So you get the top 10 names representing, over 30% of the index. So you're buying seven names. You're not buying 500. Two of those names are down year to date. So were they great? Are they going to be great again? I like their products. I think one of them is transforming a few industries. Are they dead? Is it the fact that they're down year to date means it over? So, I mean, the whole premise is a little bit of short-termism in my mind. I could argue is that if you get a smaller company with a great balance sheet and a great product, you could have explosive growth. And we see that. So, I'm back to there's rotation within the Mag 7. There's rotation within the S&P 500, and there's stock selection. I think investors are becoming more selective. That can hold up in a market where we have this GDP that's not rip-roaring risk on or awful rolling into hard recession. I'm taking my money and I'm going to cash. And I think we're in that transition point. And I think if investors lengthen their time horizon, think through what tariffs could be for 6 months or a year, we probably won't see the worst case scenario. And I think that's the biggest risk. The smaller caps are cheaper in general in valuation, and there's some pretty good companies in some of the industries have been cyclical and they're coming off bottom. So that's why I say an active selection. I know some of the Russell industries have non-earners and companies that are melting, but so does the S&P. I mean, right? To get to the bottom five or bottom 10 of the S&P and fall out, are those companies broken? Were they once great? Yeah.
This is what you wrote about value investing. Very interesting. Our definition of value, we believe value is not the opposite of growth. Overvalued is the opposite of undervalued. Okay. Shrinking is the opposite of growth. The second pillar of our investment mandate is critical to our philosophy and process. We will not own a company if we believe it cannot grow revenues and improve margins. That sounds like a okay. That sounds like a combination of the two premises, value and growth investing. Am I correct?
Not really. What that is I've been doing this a long time, right? And all my hair is gone because I've been doing this a long time. What I've learned is two things that will hurt you in this market. Bad balance sheets. And so the first pillar is financial strength. The second is that'll hurt you is declining businesses. And so I don't, it's the quote of cigarette butts, the Warren Buffett quote about don't buy bad businesses. And think about like MCI Communications might predate some of you. It was when long distance was going away. It was out there. It was supposed to be a huge dividend and shrink and be a cash cow and work for 5 years. I think it went bankrupt after 3 quarters. If the core business is declining, that's a value trap. And so yes, growth is not the opposite of the value, and overvalued is the opposite of value. Shrinking is the opposite of growth. And what I try to bring to value investing, and I've worked for three gurus over my time, Laura Sloat, Jerry Kramer, and Marty Whitman, and kind of melded what they've taught me. it's have a great balance sheet, have a long-term vision on how it can grow, and that compounding that Warren Buffett's talked about is incredibly important. And if it's going to shrink over time, it's a trade, and you're up against the clock on when do you have to sell. And so I try to make time my ally, and I've talked about that. If time's my ally, I can deal with a bad quarter. I can deal with, tariff frustration and think, boy, these stocks April 8th, April 15th are cheap. If you think a year or two ahead, what are we going to think of tariffs in 2 years, right? If 20% across the board goes in today and we get big inflation for the next year, the inflation after that, it's episodic. I'm not saying that would be good and wouldn't be good for the market, but it wouldn't repeat the second year because it's not pervasive inflation in the way that we think about it, the way it was in a stagflation point of view. This is self-induced. And we talked last time about self-induced and how much damage had been done to the economy. And because it's self-induced, it can be self-undone. And that's key for this risk. And I think that's what the market has figured out. And they call it, taco, or whatever you want to call it. The ability to undo the tariff risk. It's not like the housing crisis or the financial crisis where the banks were over leveraged, or the housing crisis was going to bring down the financial system. We can't just undo that with somebody saying, sorry, I'm going to kick something down the road 90 days. It's a big difference.
I'm just curious. People talk about tech companies, especially the larger ones being a little bit overvalued. If you just look at it from a, let's say, EV/EBITDA basis or even PE basis. But what if we divided over growth? Let's say that, we'll take a PEG ratio, PE over growth. Would it seem undervalued then all of a sudden?
Look, you can look at PE to growth. I look at cash flow and discounted cash flow. I mean, the value of any asset, right, is the cash you're going to get for it over time.
Mm-hmm.
So I'll look at any sort of ratio, and I call it a toolbox. So, I'll look at EV to EBITDA, I'll look at EPS, I'll look at price to book, price to tangible, working capital, ROIC, compare the cost of capital, DCF, but DCF, you got to be careful with garbage in, garbage out. And they all have to triangulate. You can't just pick the best. If they're all kind of giving you the same answer, then you've done your work right. And that's when I say it's a toolbox. You should get to the same answer. Um, I think the smaller caps are cheaper. That doesn't mean that I'm not a big believer in tech and AI. And just like when the internet rolled out, kind of around the year 2000, 98, 99, there was a huge productivity boom. And tell me any company in the country right now that hasn't increased their margins or improved their productivity because of the internet. In my view, AI is going to be more powerful, whether it's robots, trade reconciliation, call center agents.
Yeah.
Your plane's delayed, you call in and you're waiting for an hour. What if the AI could pick up your phone and say, hey, David, I see your plane was canceled. Want to go home through St. Louis or Chicago instead? My
Right.
God. Or better yet, what if they just find it and reroute it for you? So there's a lot of productivity to come. Um, I think you can find benefits of that up and down the chain. And yes, the large cap data center chip companies are the early beneficiaries of that and where the excitement is. But down cap, I own a couple semiconductor conductor equipment suppliers and a lot of companies, that are going to benefit from AI.
To your
So,
original point, how do we know that these smaller cap companies and mid cap companies aren't value traps and that they're undervalued for good reason and they're not just lagging behind because the large caps are eating their lunch?
well, they are lagging behind, and that is what it is, and they've really been lagging behind since 2009, when QE started, quantitative easing. We had 4 rounds of that, and then we had COVID, which put out two big spending bills, which, QE was risk on. These COVID bills were risk on, and now we're getting to a point where QE's over. The COVID spending is kind of done. Yes, the big, beautiful bill has some spending in it, but there is no big whopping support to the market from the government anymore. And I think that will take us back to a time pre 2009, 2007, where stock picking and stock selection mattered. And it's not like glory days. It's just it is what it is. Um, and I think if you do own the ETFs that are dominated by five, six, seven companies, and those companies start to plateau, as some of them have for I mean, remember, we don't own Amazon, but Amazon plateaued for a while in the 90s. Walmart was a big darling. It plateaued. Some of these companies that might be expensive, I'm not saying, hey, they're going to crash. I'm just saying, the compounding at 20, 30% that they've had is unlikely to continue into the foreseeable future. It's a law of large numbers. In that sense, if investors start rotating away from the S&P, the numbers down cap can be powerful, right? So 1% of the S&P, and think about how much the S&P is up, right? Over the last 5 years, 10 years. Rotate 1% of that down into the Russell 2500 value. You got to buy over 10% of the index. Rotate it down into the 2000 value, you got to buy 33% of the index. The market caps are smaller, the stocks are thinner, and you can buy some. And that's why I say don't buy the ETFs. Look for individual stocks that can be beneficiaries of that.
Okay, so let's go bottom up then. On a sector basis, in your newsletter, you wrote that you like aerospace and defense, banks, regional banks as well, and semis. We talked about semis briefly just now. Let's start with semis then. The capex cycle should reaccelerate over second half of 2025. Tell us about that.
Yeah, sure. So you can look at the big cap names, right? Well, first of all, the powerhouse NVIDIA is kind of stands on its own in the AI chips. But if you look at a Lam or an Applied, wafer starts have been kind of pushed sideways for the last couple of years. They haven't been strong. They haven't been weak. And we haven't seen a lot of spending by the customers of Lam and the customers of AMAT for new fabs. At some point, if you believe AI, if you believe that we're in a shortage of data centers and sensors and chips and everything, that cycle is going to change. And I grew up in Detroit, and cycles can be powerful. And I'll tell you, the longer a cycle goes sideways or under trend, the more powerful it will be on the upside. And I think that's where we are in semis. And if you look at up and down the small mid cap semiconductor capex plays, a lot of them are flat to down year to date. And that's the argument I'm making is the large caps and the small caps play in the same pool. The small caps supply the larger guys. It's not like they're out trying to replicate what the larger guys are doing. The larger guys have a supply chain, and the part of the supply chain that's part of that should get pulled along. And I think it will. And I just think they're under trend. A lot of them have great balance sheets because they're cyclical industries and they've been good stewards of capital. And those are the ones I want. The ones 5, 6, 7 times EBITDA now I have no interest in, but a lot of them have net cash on the balance sheet. And so I can wait. And if it doesn't come this quarter, maybe it'll come next quarter. Maybe it comes at year end. I've got a 2 to 3 year horizon where I think some of these names can compound quite nicely in times my ally.
How do they compare to the bigger names, the AMDs and the NVIDIAs of the world in someone's
Oh,
portfolio?
they haven't done as well year to date. And, they supply those bigger names, right? Especially, I'm talking about, Lam and Applied basically sell to, the Taiwan semis and everybody else. So they're the suppliers as you come down the chain. So, NVIDIA is different. NVIDIA's got kind of the hot products in a niche, and others are scrambling to catch up. And you can make the argument that Google or Amazon or everybody else is going to work on their own chip and, chip cycles and Moore's law and competitive advantage. That's not where I'm going. I'm saying that if wafer starts are going to pick up and we're going to use artificial intelligence into intelligent devices and cars and repeaters and in your home, there's going to be a lot of demand for semiconductor and communication and power and processing that's not doing the AI, but is feeding the data points to the AI or receiving the instructions from the AI. And that capacity will have to be built or will have to be seen, and we haven't seen it yet. So I kind of like that view where there's a strong mega trend and you've got a segment that's lagged, they're critical because they're suppliers to big companies and they have good balance sheets. So if I'm early, I'll take that because time will be my ally. Because there's that second point we talked about earlier. It's great. It's not like they're going to shrink. It's not like chips are going to go away and NVIDIA is going to sell every chip that's ever made. So I think I have time and I think these companies can grow and I don't think the sector is shrinking.
Okay, let's move on to defense. Are you banking on more conflict?
You know, Unfortunately, we do have a lot of conflict in the world, and I hope there's peace tomorrow. That won't change aerospace. It's aerospace and defense. First of all, on the defense side, the articles are now written about how our stocks are depleted for supplying Ukraine and everything else, and the changing nature of warfare. I think drone warfare and anti-missile if we built an Iron Dome, there's going to be a lot of spending. And in the big beautiful bill, there's 150 billion more in spending. I think if peace breaks out tomorrow, that money's still going to get spent because one, we got to replace what was used, and two, we have to reconfigure what we have. Then you look to NATO, and that 2% goal is now 3.5 on procurement plus 1.5 on infrastructure. And then you have, Israel and everybody else trying to replenish. So I think the defense side, there's going to be good pull through. If you look at commercial aerospace, we had something like 641 orders in the second quarter and 300 and some deliveries, maybe 304, 305. I can't remember the exact number. The book to bills are 5+ years. Boeing and Airbus, their problem is they cannot deliver the product quick enough and their customers are angry with them because they can't get the product quick enough. That's a really good problem to have. And all they have to do is fix their production processes, and they're working on it. And I think you even saw United say about Boeing, they're back. I don't know if they're back, but they are ramping production. So with military and commercial and even space pulling through the supply chain, I think up and down cap, there's a lot to do. I don't think that view is as isolated or unique as it was when we last time talked. I think it's becoming very consensus, but I think it still has legs. And I think we'll see strong earnings and revenue growth for these companies for a time. And, they probably can push higher. I mean, things go further than maybe value investors think they could.
And on the banks, okay, what's your rationale there? Maybe a steepening yield curve is known to have improved margins for banks as they land on usually they land on the longer end of the curve, and
Yeah,
they borrow on the
banks,
short end. Yeah.
my bank view is neglect. I think banks have been undervalued and under scrutiny since the financial crisis. And the banks of today are completely different than the banks of 2007. The capital levels are triple, the ROEs are quadruple, I mean, across the board. Love or hate Elizabeth Warren and her efforts to strengthen the banking system were there. And CECL has changed the way banks book loan loss reserves. You have to, when you book a loan, you book it for the cycle. You don't book it for the period anymore. And even in the first quarter, some of the weakness that we saw was because even bank CEOs thought we were going to go into recession, so they up reserves. And what we've seen so far in the second quarter is provisions down. And because we haven't had a recession, any bad credits haven't hit like a sledgehammer or hit a brick wall. There has been time to work them out one by one and work them down the road. Even commercial real estate, the fears that it was going to roll over, we've had a little back to office and time to work through these loans. And I always thought that with loan to value ratios of 50, 55, these banks were never really going to get hurt. It was the equity sponsors. So the large cap banks have been great. Again, I think the results over this quarter were really, really good. And I think you've seen even the results of CCAR say you can buy back more stock and you can pay more dividends. And now we're talking about easing merger rules for big deals. That would be a big deal. The regionals have underperformed. The smallers have underperformed. Size has been a factor. They too have improved balance sheets, but we've also seen the Office of Control of Currency eased merger rules for some of the regionals back in the spring. We're talking about easing the $100 billion cap before they become, I think, a cap four and have to put up, stricter capital levels. Maybe they'll move it to 150. Maybe they'll get rid of it. That would be a positive for mergers. But these things are, by and large, 10, 11, 12 times PE. They're paying good yields. Again, if we don't cut interest rates, the net interest income should be better. But again, if you have a bank that's managed correctly, hopefully they've kind of hedged their interest rate risk, so it won't be a problem either way. Um, they are buying back stock and bank deals. And we just saw a bank deal, a super regional. We don't own it. Huntington Bankshares, pretty big bank, made a deal have worked. And the reason they work is you can almost take out 100% of the cost X branches of the acquired target. I mean, the computer systems and all the corporate office functions, if you're running $10 versus 20 or 30, if you've got the right computer system, it's a scale issue. Yes, the bank's branches, can get consolidated, but buying good branches and increasing your footprint has also worked. So I like the space. I think they're undervalued. I think they're neglected. I think they're underowned. And I think people just think recession, sell the banks. Recession fear, sell the banks. Um, and they don't have tariff risk, right? The U.S. regionals don't have a lot of tariff risk by definition. So it's a place that could work. Again, if we don't roll into a hard recession.
You wrote in your note that the supplementary leverage ratio, the SLR, is being discussed by the Treasury Secretary Scott Bessent and his allies. They're undergoing a review of potentially changing it, making it easier for banks to add treasuries to their portfolio. Why, and how is this significant?
Well, Bessent has the argument that if banks buy more treasuries for their balance sheet, the yield on treasuries will fall. And we haven't talked about why the administration's focused on rates and yields, but we could. I don't know. I don't think so, maybe. But what they're talking about is eliminating the need for banks to hold capital against treasuries, meaning the US is still the strongest house in the world, and a treasury shouldn't really have to be reserved against. So if the SLR changes and you don't have to hold a lot of reserves against treasuries, you can remix your balance sheet, take off riskier asset classes, which probably pushes the yield on those higher and might push the yield on treasuries lower depending on the on how much is bought or at the margin. But what it does is free up capital at the banks for more share repurchases, more dividends, more investment, whatever they want to do, it frees up extra capital because you're not holding reserves like you're forced to on riskier asset classes. So to me, that's the power of the SLR. And remember, the SLR doesn't apply down cap. It's more the OCC that which regulates that. And it's things like the $100 billion asset cap and merger rules that impact those, which if those rules are eased, and mergers come back down cap. You don't remember probably the mid to late 90s when the merger frenzy went for regionals, they were two, three, four times book value. And everybody loved the bank. Everybody wanted to own them. And this was a decade before the housing crisis. So, if consolidation can restart, and again, that's not really my case, I'm just mentioning like that'd be the Goldilocks scenario.
Yeah.
There's room to go.
Well, that concludes the sector outlook. So let's finish off then on your discussion on rates and why the administration is obsessed with rates. You brought that up several times. Let's talk about it.
Well, they are, right? And the administration. If you listen to Scott Bessent, I think he's the only person you should listen to, right? Because he's, in my view, the adult in the room. He talks about the problem with the economy, and I think everybody knows this, is the debt of the USA and more so the budget deficit. And there's really three ways to cut the deficit, right? One, you can raise taxes, and this administration's really not going to do that. Two, you can cut costs, and we had Doge, and we're nowhere near 2 trillion. So three, you can grow the economy. And if you can grow the economy to his 3% goal, you increase the tax base, but you also increase the monetary impact, the cyclical impact of money running around the economy, and taxes go up, not because the rate went up, but because there's more business. So that's where their obsession is: grow the economy, increase the tax base, and attack the deficit that way. If they can have rate cuts, that helps that scenario. I'm not saying that's a plan that's going to work. I think that's what they're trying to do. And it just explains their action and explains their focus on rates and why they want rates lower. I mean, if, when Trump says something like 1% treasuries, of course that would spur GDP growth. And that's what he wants. I think it would also spur inflation. And at this point, I'm not sure that's appropriate. And that was a rate construct for a unique time in our history. But that's why I think the administration wants rates lower. So on the margin, any rate cuts kind of helps their plan to grow GDP. And I think that's the whole thing about tariff: bring business home to grow GDP. Whether it's a good plan or a bad plan, that's what's behind it. Bring business home, increase tax revenue, and tax the deficit through that.
You know how many times people have asked me in private conversation over dinner, is Jerome Powell getting fired? And I had to tell him, well, he can't legally be fired, but this may be his last term. And so if this were his last term, then the argument is that, well, rates coming down would be inevitable because the Trump administration will likely appoint somebody more privy to listen to them. Can you evaluate that?
No. I mean, look, I don't think they'll fire him. And I think, and again, Besson keeps saying no. And I think he understands that that probably wouldn't be the best thing. And again, don't worry about it because he's not here in about a year or so, right? I mean, and he's not going to be nominated again. And I think everybody's made that clear. Even Besson has said their searches are already underway. So again, a year is not a long time if you think about it in the grand scheme of the Treasury, the budget deficit, right? The question is, does changing the head of the Fed change the other governors in the voting power? And do we even get cuts? And again, I'm not talking 25 or 50 and kind of tweaking on economic growth. I'm talking about structural big cuts. I don't know. I don't think so. So there's a lot to handicap there, a lot of what ifs. I think, as you said earlier, if we get a couple rate cuts in the back half of the year, if the economy slows, that's great. It can help GDP stay strong. If GDP is stronger than the 1.4, we're not going to get any rate cuts. But hey, a strong GDP probably supports the stock market. So be careful what you wish for, right? Rates are seen as a bailout in a way. If we don't have to cut rates, it probably means GDP is strong, corporate earnings are strong, and hopefully the stocks follow that path.
What other tools do they have in their toolbox to lower rates besides making the Fed do it? They could potentially buy back treasuries, right? Wouldn't that do it?
Well, that's QE, and we did that. And now we're not doing that anymore. And that's what I say. So,
Yeah.
QA, we held quantitative easing because we had rates so low, we couldn't cut rates anymore, right? And so we bought treasuries and we bought mortgage backs. And now we're cycling those back out, letting them mature out, not reinvesting the coupons. We're anti-QE. And that QE, when it was on, spurred a risk on, get into the market, buy the ETF because everything's going up. And that's why I say when QE's over, now the government, in a way, is anti-QEing, and that could, I just don't think that's a risk-on mentality anymore. And I don't think it's an argument to stick with an index that's cap weighted to 7 names.
Chip, excellent thoughts. Thank you very much for your time today. Where can we follow you in the meantime?
You can check my website, reweyassetmanagement.com, and it's Rewey.
Okay, we'll put the link down below, so make sure to follow Chip there. Appreciate it, Chip. We'll speak again soon. Take care for now.
All right, David, thanks for the time.
Thanks for watching. Don't forget to like and subscribe.